I'm going to go over a typical accounting question that you might be asked in an investment banking interview. And these kind of questions, for example, you might be asked, how does a $120 purchase of an annual subscription affect the three statements? Let's pretend we're the company Grammarly or any company that accepts annual subscriptions. So we're going to get a bunch of cash up front, but the service itself is actually going to be delivered in the next year. So in year zero, actually, nothing happens on the income statement. Because if we haven't delivered the service, the revenue can't be recognized. But the cash is, of course, affected. We do receive that cash, and we'll call it changes in deferred revenue. And you'll see why in a second. So we have the 120 of cash here, as you can see, coming in. And then in the balance sheet, we start with cash up 120. Notice that deferred revenue is also up 120. That's a liability account. This account represents revenue that we still have to earn, in the sense that we haven't delivered the service yet. So we still have to deliver the service before we can take this off the balance sheet. Now, in year one, we will have delivered the service. And now we can recognize the revenue. So when we recognize the revenue in the income statement, you'll see that we have 120 revenue here. It's a 40% tax rate. So, we have to also account for the tax. So after the tax rate, net income is up by 72. In the cash flow statement, we always start with net income, and you'll note that it's up by 72, but we have to adjust for any non-cash changes. The change in deferred revenue, that's the change, because we're going to be decreasing that account on the balance sheet. So we end up with cash down 48, and on the balance sheet, we start with cash down 48. In the deferred revenue, you'll see that we're down by 120. So this deferred revenue account, which is a liability account, started at, it was 120 in year zero. Now it's declining by 120, so back to where it was before the subscription. And that's to represent the fact that the revenue has been earned now, and it's no longer a liability. We've already delivered the service. Finally, retained earnings is simply connected to net income, so it's up by 72.